The U.S. Federal Reserve announced it is working with other central banks to make dollars available in order to limit cash flow concerns in the global financial market. The central banks collaborating include those of Canada, England, Japan, Switzerland, and the European Central Bank. But despite the recent collapse of two prominent U.S. banks, the Fed is still expected to raise interest rates again this week, part of its ongoing effort to curb the inflation created by the spending policies of the Biden administration. What can we make of these developments, and how concerned are members of Congress about the issues transpiring in the banking industry? Joining me now to discuss this and more is Congressman Bill Huizenga. He's a member of the House Financial Services Committee. He represents the 4th Congressional District of Michigan. Congressman, welcome back to the program.
Tony, good to be with you. Sorry, this is less than ideal in an empty ballroom at our issues retreat, but this is important stuff, and I'm happy to be able to join you.
Well, Bill, I appreciate you stepping out of the meetings to join us. So before we jump into the banking situation, give us kind of an overview of what House Republicans are discussing in Orlando this week.
Yeah, the main thing is translating the pledge to America that we had put together leading into this election with actions now. And I think people have been pretty pleased with the direction that we have been going, maybe a little frustrated with the speed of this, but I just ask for a little patience. We have to walk before we run, before we sprint here. And there's so many different directions that this can go, from the Biden family themselves to the Securities and Exchange Commission and other regulatory agencies. Certainly, this banking issue has dramatically altered sort of the timelines of what we had planned out for a few things. But have faith. Jim Jordan's still doing his work. Jamie Comer's still doing his work. On our Financial Services Committee, we're still doing our work. I also have just joined the Foreign Affairs Committee. We just had the first hearing on the departure, abandonment, frankly, of Afghanistan and how that went. That was in our committee a couple of weeks ago. So lots of things happening while we're in Washington. Right now, it's how do we strategize and talk about where we are going? Debt ceiling is certainly one of those main issues among the others.
Yeah, I mean, it's amazing how one event can kind of upset the entire apple cart, shift focus to address a crisis, because it seems like under this administration, there's one crisis after another. Obviously,
yeah,
the banking industry being one right now. But I want to go back to something before we get to that you mentioned. My observation, Congressman Huizenga, and I've been doing this about 20 years, is that coming out of the selection of Kevin McCarthy as Speaker, and it was, people were moaning, wringing their hands about it. And I thought, hey, this is the process, let it work. I actually continue to see what appears to be strong unity among Republicans. Like you said, maybe not moving as fast as some would like and as their supporters would like. But I have to tell you, I think Kevin McCarthy is keeping his eye on the ball and leading the Republicans forward.
He absolutely is. I think our entire leadership team has done a very good job with that. And frankly, Tony, here's what had happened. Over 4 years of being in the minority, it was easy to kind of hit that no button, right? That's we were all opposed to a lot of the direction that this was going. But what we didn't have is the constructive internal discussions that we needed to have. And frankly, half of our conference, literally half, has never served in the majority now. So that means they've never known what it's like to be in the majority. And what I observed myself was you had people who used to get together and talk about issues, kind of had quit doing that. Others who never even thought they could get in a room to talk about some of these issues and had never attempted to, were suddenly forced into a situation and into that proverbial and sometimes actual room together to say, hey, folks, we got to hammer this out. What direction are we going to go? Because if we don't, we are literally effectively handing over the majority back to the Democrats. And I don't think any of us want to go that direction. And so while it was difficult, that 15 votes over 7 days was a tough kind of period. ultimately, I think we have emerged from it stronger and in a better spot than certainly a lot of people expected, and that way more better than, or way more advantageous than what the media thought or the Democrats that are on the other side of the aisle thought.
That's my observation, precisely. So let's go down to those issues. Let's go to the financial issues top of mind with what's happening in the banking industry. That's one of your committees. You sit on that. Give us the latest. What's the sense there in Orlando?
Yeah, and actually, I was part of a lot of internal conversations that we've had over the last number of days. And I want to say this first and foremost, Tony. The banking system here in the United States is safe. It is. There's some hiccups, but between the FDIC and some of the other provisions that have been put in place, it's stable. Now, what I'm hearing from some of my more local and regional banks is that they're frustrated with sort of this seemingly two-tier system of bank regulation. And that's something that we are certainly getting at and need to deal with. But first and foremost, we need to make sure people understand their money is going to be safe. Now, what that means is we have some decisions to make. Do we do a temporary increase of that FDIC insurance, for example? And this would be, this would affect a lot of small businesses, certainly seasonal businesses. Think of yourself if you're a small landscaper. And, right about now in February and March, you might not have a whole lot of cash on hand. But in September and October, you might have a lot of cash on hand, and that would exceed that $250,000 insured level. So how do we deal with those kinds of situations? Do we do something temporary? If we did that, we would literally have to go in and have a vote by the House, the Senate, and signed into law by the president. Because right now, what the law says is that you can go on a bank-by-bank or case-by-case basis and do what they declared with SVB, that Silicon Valley Bank, and said, okay, we're going to cover everyone's deposits. Now, having said that, and we want to make sure that we've got the sort of those jitters under control, we have some really tough questions that we need to ask. And was SVB treated differently because of who was behind it or who maybe deposited their money there? Why did BlackRock, of all people, who got brought in to do an analysis, they raised red flags? It was ignored by the bank and the board. The Federal Reserve out of San Francisco raised red flags. It was ignored, but they didn't take the next step. They didn't do anything about it. So we have to ask the regulators what their role in this, in addition to mismanagement of the bank.
So you think it's isolated in those particular banks, or is this more of widespread? I mean, we look at the ESG, the woke policies that are there in the banking industry. We have the obviously this almost perfect storm where you've got money that has driven up interest rates or inflation, and then you've got interest rates going up by the Fed. So is it a combination of all these factors, and how do we work our way out of this?
That's the magic question, and we have to work our way out of it step by step. There is no magic wand that we're going to be able to wave here and fix it all. But those issues that you brought up certainly are part of it. In SVB's particular situation, they took an excess amount of cash, put them in long-term treasuries, which at the time were yielding a higher interest rate than short-term treasuries, except we have something called the inverted yield curve right now, where short-term is actually returning higher interest rates than long-term bonds. And having these hold-to-maturity bonds suddenly put a cash strap on them, and they found themselves in a hyperinflationary situation where you've got the Fed dramatically increasing interest rates, where they got caught behind that curve, and they couldn't cover it up. They couldn't make it up by selling assets. So the regulators had to step in. Now, the question really is could they and should they have avoided this by getting involved earlier and really looking at that interest rate exposure that they had? Mm-hmm. And to answer that part of that question, yes, there are a number of other banks that have similar situations, but none that we've really seen with as much exposure as SVB had.
All right. Congressman Bill Huizenga, again, I want to thank you for stepping out of the issues retreat and talking with us today. Always good to see you.
It's good to see you too, Tony. Appreciate it, and keep up the great work.
All right. Thanks so much.